I talk to a lot of people who are earning really good money, two, three, sometimes $400,000 a year. And a surprising number of them still feel like they're behind. After going through their numbers, I keep seeing the same thing. A lot of these people are handing the CRA somewhere between $20,000 and $30,000 a year that they genuinely didn't have to give up. And it's not because they did something reckless. It's because nobody ever actually sat down with them and explained how taxes work at this income level. If you're a physician, a dentist, a business owner in Canada, you have a silent partner. And that partner takes about 53 cents of every extra dollar you earn. Most people just accept that as a fixed cost, but that's actually a mistake. Your tax bill isn't fixed. It's variable, and it can be managed. I'm Jim Pan, an advice-only certified financial planner and owner of Panorama Planning. Today, I'm going to walk you through the 3 biggest tax leaks I see over and over again, and exactly how to plug them. Most people have heard of asset allocation. That's your mix of stocks, bond, cash, and so on. But there's a concept that's actually more important, and almost nobody talks about it. It's called asset location. It's not about what you own, it's about where you hold it. Here's the thing that most people don't realize. In Canada, not all investment income gets taxed the same way, and the differences are pretty significant. For example, interest income. Think of GICs, bonds. They get taxed at your full marginal tax rate. And depending on your province, that can be as high as 54%. And foreign dividend income from US stocks or international stocks, there's the same deal, full marginal rate. Although there's a foreign tax credit that you might be able to claim. In Canadian dividends, they get a slightly better treatment because of the dividend tax credit here in Canada. But at the top marginal tax rate, you're still looking at around 37%. And it can reduce your income tested benefits. We'll talk a little bit about this later. And then there's capital gains. They're the most tax efficient. Only 50% of your gain get added to your taxable income. So at the top marginal rate in Canada, you're paying around 27%. Here's the mistake I see quite often. Many people put their safe investments, their GICs, cash, bonds in their non-registered accounts. And then they put their growth investments inside their RRSPs and TFSAs. And I totally get the logic. I mean, you want your safe money accessible, and you want your growth to be tax-free. You don't want to deal with withdrawals if something comes up. But here's where the math starts working against you. Say you got $200,000 sitting in a GIC paying 4%. Well, that's $8,000 in interest income every year. If you are in the top BC tax bracket at 53.5%, the CRA is taking $4,280 of that. So you're left with only $3,720 after tax. And your actual net rate of return is 1.86%, which, by the way, is below inflation. So your purchasing power is quietly shrinking while you watch your GIC grow. Now, if you move that same $200,000 GIC inside your RRSP or TFSA, assuming you have the contribution room, the tax on that growth is fully sheltered. You pay nothing. You just save $4,280 a year without changing a single investment. Okay, but what if your registered accounts are already maxed out? This is where it gets interesting. After actually sitting down and thinking it through, maybe you only need $50,000 in a truly accessible emergency fund. The other $150,000? Well, that's long-term money. You're not going to touch it for 15 or 20 years. So what happens if you redirect that $150,000 into a low-cost, diversified equity index funds in your non-registered accounts instead? That ETF portfolio isn't generating taxable interest income every year. It's mostly growing through capital gains, gains that you only get triggered mostly when you sell. And even then, again, only 50% counts as income. So instead of paying 53.5% on $8,000 of that interest income from GIC every year, you're now generating maybe $2,000 in taxable income from that $50,000 annually and paying around just over $1,000 in tax. That's $32,000 in annual savings just from moving things around. And on top of that, you're giving that $150,000 a real chance to grow. At 7% average return, the difference in after-tax wealth after 10 years of compounding is over $100,000 compared to the same $200,000 GIC. So it's the same $200,000 just placed in different investments. So what should you actually do? Well, the fix depends on your situation. If you genuinely need safety and predictability, keep your GIC, but try to hold it inside your registered accounts where the interest is sheltered from tax. But if you got a 10, 15, 20-year time horizon on that money, it's worth to think about whether investments generating only interest income is actually the right tool. Maybe you're leaving a lot of growth on the table. Okay, this one genuinely surprises people when I bring it up. Most high earners assume that Canada Child Benefit doesn't apply to them. They say, well, I make too much money, that's not for me. But it's actually wrong. And that assumption is costing a lot of families thousands of dollars every year. The CCB actually phases out gradually based on your adjusted family net income and the number of minor children you have, which is your gross income minus eligible deductions. Things like RRSP deductions, CPP, childcare expenses, professional dues, it's not based on your gross income. So even at a household income above $250,000, depending on your deductions and how many kids you have, you might still be entitled to something. For the 2025 tax year, the first clawback threshold kicks in at $37,487 of adjusted family net income. Once you cross the $81,222, a higher clawback rate kicks in. For a family with one kid, the reduction rate is 7% in the first range and 3.2% above it. 2 kids, the reduction rate is 13.5% in the first range and 5.7% above the second threshold. 3 kids, 19% and then 8%. 4 or more kids, 23%, then 9.5%. So let me show you how this actually plays out. Say you and your spouse have 2 young kids. One of you is staying home, the other is earning $250,000. You're past both clawback thresholds, so the 5.7 rate applies. Stack that on top of your 45.8% marginal tax rate in BC based on that $250,000 income, your effective marginal tax rate on the next dollar you earn is actually over 50%. Most people don't realize that's happening. And here's where it gets interesting. If you make a $50,000 RRSP contribution and bring your adjusted family net income down from that $250,000 to $200,000, 2 things happen at the same time. First, you defer roughly $23,000 in income tax on that RRSP contribution. And 2, because your adjusted family net income just dropped by $50,000, your CCB payments go up. For a 2-child family in that income range, you can recover around $2,850 in additional CCB payments that were effectively just sitting there. So that one RRSP contribution is recovering close to $26,000 for you with both benefits combined. It's cutting your tax bill and increasing a government benefit. That's something that only shows up when you plan ahead. Okay. So this one is specifically for the incorporated professionals and business owners watching this. The advice you probably heard goes something like, pay yourself just enough salary or dividend to maximize your CPP or cover your expenses, and leave the rest inside the corporation for tax deferment. And for a long time, that advice made sense. But there's a piece of context that often gets left out of that conversation. If you pay yourself a salary or dividend and invest the money personally, that's outside of your corporation, it has 0 effect on your small business deduction. That's the lower tax rate of 9 to 12.5%, depending on your province. That applies to the first $500,000 of your corporate net income. But if additional cash is sitting inside your corporation and you invest it inside the corporation, generating interest, dividends, rental, or capital gains income, a specific rule called the passive income grinding rule kicks in. And if your corporation earns more than $50,000 in passive income in a year, the government starts reducing your small business deduction. For every dollar above $50,000 threshold, your business limit drops by $5. And once the passive income hits $150,000, your small business deduction is completely gone. And that matters a lot because the business income that should have been taxed at the lower rate of 9 to 12.5% is now getting taxed at the general corporate rate of 26 to 27%. That gap can mean an extra $67,000 to $90,000 in tax. I've seen this catch business owners completely off guard, not because they made a bad decision, but because nobody flagged it until the damage was already done. There are two other things in the salary versus dividend conversation that get overlooked a lot. First, if you take dividends and no salary at all, you're not generating RRSP contribution room. You have no employment income means no RRSP contribution room. And another thing about dividend is it is grossed up. So on paper, you actually appear to have higher income than you actually receive, which impacts the CCB calculation. And second, you're not contributing to CPP from the dividend income. Skipping those contributions feels like a win in the short term, but you're also walking away from a guaranteed inflation index pension for the rest of your life. Sometimes that trade-off made sense if you are a disciplined saver, but it should be a deliberate choice, not something that just kind of happened. So the fix here isn't a simple salary versus dividend formula. It's building a proper compensation strategy that accounts for your RRSP room, your CPP contribution, your personal tax bracket, and how much passive income is building up inside your corporation. This is exactly the kind of thing where your accountant and your financial planner genuinely need to be working together, not in separate silos. So what's the message that actually connects all these? It's advanced tax planning. Tax filing is looking in the rear view mirror. It's based on what already happened. Tax planning is looking through the windshield. It's proactive, and it happens before the damage is done. What a high-earning family actually needs is a plan that answers three questions. First, where is your income coming from? Is it from your employment, your corporation, or maybe both? And two, where are your investments sitting? Are they in the most tax-efficient account for that type of income? And three, how are you managing your adjusted family net income to maximize government benefit and minimize clawbacks? When those three things actually work together, the leaks stop and they're plugged. Look, if your tax bill is your single largest household expense right now, probably bigger than your mortgage, bigger than what you spend on life, you have to stop treating it like it is fixed. It's not, it's variable. And with the right planning, it can be brought down significantly. In my next video, I'm going to walk through the biggest wealth building mistake I see high earners making in Canada. And it's costing people hundreds of thousands in wealth they could be building right now, not decades from now. And most people have absolutely no idea it's happening. I hope to see you there.